philsgang.com.
The stocks discussed on Phil's Gang are not in any way a recommendation or solicitation to buy, sell, or hold. If considering acting on information presented, we first recommend you seek out a competent, licensed professional for advice. Get ready for the radio show that tells you what Wall Street doesn't want you to know.
Oh, I'm a money magnet. Money, money, money's coming to me. Money sets me free. I'm a money magnet. Money, 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 money's coming to me.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Radio Network. With your host, Phil Grande.
And welcome to my podcast, Phil's Gang Podcast and Radio Show. Well, we're wrapping up, coming to the end of the year. And I want to discuss not just the returns so far, which the Dow's up about 15, the S&P's up about 26, the Nasdaq's up around 33, but I want to discuss the 401k. Now, the 401k compared to the pension fund, you can't compare. The pension fund has been a better product, there's no question about it. In fact, the 401k, the person who, Brenner, who started this thing, the 401k, he's come right out and said that, that he feels it's a failed experiment because the expenses, they're not what he started with. The expenses are too high. The commissions are too high. And the 401k, if you look at over a 20-year period, the annual return in a 401k is about 5 to 8%, but more towards the 5% because of the hidden fees. Now, the hidden fees, again, over all the years, there's been a lot of pressure on the industry to divulge these fees because they've been hidden. They finally are doing a better job divulging the fees. But the problem is they may not be hidden any longer, but to try to find where they are, you have to have a degree from MIT. So that's, they're in a few categories, okay? Now, you look under total assets, base fees, total operating expenses, expense ratios. Those are three categories. So it's total asset, based fees, operating expense ratios. And also you have the terrible 12B1 fees, which are fees paid to those who sell you your 401k plan. Okay? And that, again, becomes a very big problem. And one of the biggest problems with 401ks instead of the pension fund is that the 401k, the minute they found this little niche in the law, they could take the 401k expenses the company has and shift those expenses all over on top of you, the employee. That's when it became, as Brennan said, a failed experiment. When they caught up with that little trick and the 12B1 fees, you combine those, it's just a terrible product. And also you got to understand the 401k managers in the company, when they select the mutual fund, remember what a 401k is. That is really just a tax code. 401k is a tax code. They then take and purchase from the mutual fund industry these funds that they stick into your 401k, and you get a menu, and there'll be a group of stocks that you can select, and the mutual funds that you can select. But what you have to understand is that the menu of mutual funds they offer you, okay, to choose from, now the company buys those, and how they select them is not by performance, how well that package is. So they buy a mutual fund, they're going to stick it in your 401k. You're working for a company, you think, well, the company went out, they did the best for me, they found the best 401, the mutual fund to stick in my 401k. No. The companies, the terrible thing with 401ks, the menu of mutual funds they offer you, the way they select them is by the size of the kickback. That's right, the kickback that the company receives from the mutual fund provider. And that's a terrible thing about the 401k. And remember, too, there's no fiduciary relation between you, the employee, and the company. You, the employee, and the 401k manager. The 401k manager, his fiduciary is with the companies, with the shareholders, not with you. But the dirty trick is when they go out and they buy these mutual funds, not based on their quality, but based on the size of the kickbacks. And the bigger the kickback, the worse the performance you get from that mutual fund that's going to go inside your 401k that you select off a menu. So that's, again, and the other thing they do, companies that offer 401ks, they don't offer any standardized investment education. Now, if you're with a company that's offering a pension fund, they offer you an investment education, a standardized investment education. They want you to be educated, but not the companies that offer 401ks. They want to keep you in the dark. They want to keep you in the dark because here's the problem is the 401k, the person who has a 401k, he doesn't know even the price of that 401k. He has no idea what he's paying for it. He'll go to all kinds of lengths when he goes to a market and buy a tomato or a melon. He'll squeeze it and smell it. Or if he goes buys a shirt, he'll take the fabric and test it. But when it comes to a 401k, nothing. They just believe that the company is doing a good job for them and going to say, here's your menu. We're putting you in a 401k. Now, here's the menu of the funds that we shove inside your 401k. They don't realize they're the worst because they pick the ones where they get the biggest kickbacks. Now, and the other thing about a 401k, the 401k manager is a loser. That's right. He's on salary. He has no incentive. People who go manage 401ks, they don't make money when they're trading themselves. They're terrible at it. So that's where they all end up at. They all end up becoming 401k managers, so they get on a salary because they couldn't make it on an incentive. A pension fund manager, he doesn't want anything to do with a salary. He has great incentive to help you, to be loyal to you, to make you money, because then he makes a boatload of money. Not a 401k manager. They get a set salary and that's it. So the pension fund manager, that's where you want to be with. You want to be with a good salary, but they don't offer pension funds anymore. They don't offer them anymore. That when they started to outsource in the 70s. That's why they finally got rid of the pensions. They said, oh, this is too expensive. So what we'll do is we'll take the tax code called 401k and we'll trick people and we'll just shove a bunch of garbage, a mutual fund inside the 401k, and people have no idea. It's just 401k is a tax code. That's all it really is. And they screw everybody by shoving this crap inside the 401k. But you can't convince people. The other bad thing about a 401k is when the markets start, even if you get, let's say, they claim 5 to 8% on an annual basis, right? Well, you do far better with the spiders because you don't have all those fees. You do much better with spiders. And you don't make a 5 to 8% return on an annual basis over 20 years. Sure, everybody's making money this year, okay, year to date. I mean, the S&P's up about, 26%, something like that right now. And the 401k's up about, 22%? Sure, okay, because because we haven't had a correction yet. Now, the problem with the 401k is when we do have a correction, they're not allowed to sell short. And also, if the market starts to crash, you can't get out immediately. No. You have to wait around. You don't get out right away. And you don't have the advantage or the manager taking your stocks inside your 401k and shorting them. So it's a horrible product. So again, as we come to the end of the year and you're setting up yourself for the next year, I'm not saying get out of your 401k, but get educated about your 401k. And you understand it's not what it's cracked up to be. It's a terrible, terrible product. That's not my saying alone. It's the fellow who started the 401k who says it's Ted Bennett, that it sucks. And that the 401ks are not what they're supposed to be, what he started out with. They're a crime. Okay. So last week we had this big drop in the dollar, right? Here, we'll look at it on our chart over here. Put up the UUP. And everyone's saying, what on earth happened with the dollar? Okay, the dollar had this big drop. Look at this right here. Huge drop. Now, they came out, Powell, they said, oh, and the jibber jabbers on all these TV programs came out and said, oh, the reason, because we had an FOMC meeting, and that meeting resulted that in the fact that we're going to only cut rates twice, 2 more times instead of 4. Because, again, they failed to meet their 2% target, inflation target. Inflation's going up. But wait a minute. If inflation's going up, what in the hell are you doing cutting rates? You should be raising rates. Instead, they're cutting rates. It makes no sense unless you're the Federal Reserve Chairman. Then it makes sense. So never have we ever cut rates when inflation's going up. Now, remember Powell's responsibility at the Fed. He's supposed to grow the tax base. In other words, his job is to expand employment, because that's where we get all our tax revenue from, okay, that takes care of everything, the bridges and roads and everything else. So that's the most important thing, is to expand employment, and so expand our tax base. And then his next thing is to keep inflation low. So to keep prices on stuff we buy stable, not up and down all over the place, and make them affordable. And to keep interest rates very moderate. He fails at all of those. Every chairperson of the Fed do a terrible job. They fail at it all. Because why? Because they're not there to help us. They're there to help Wall Street, not us. Now, Trump left Biden inflation of 0.3%. Now, never mind, he drove it up to 9%, Biden. But let's go today. We're at 2.7%. It was at 0.3. That's 0.3%. Now it's at 2.7. And now he's saying he's going to cut rates instead of 4 times, twice, and that's going to fix it. How do you fix that when you're cutting rates? You're supposed to raise it. Now the problem is that spending has gone wild under Biden, and Powell never had a set to tell Biden, to tell Harris, to tell Congress, knock it off. I'm resigning if you don't get a handle on the spending. But he kowtows to them because he wants to keep his job. The problem is the deficit. You're spending more than you're taking in. That's a terrible thing. That's what they're doing, spending. So when they're fighting inflation, they keep raising rates. Well, when you keep raising rates, you're raising the cost of the interest on the national debt. The annual interest rate keeps going up. When you're spending more than you take in, and you keep saying, boy, there's inflation, we got to raise rates. And the more you raise rates, that means the rates go up on your interest. So right now, our interest, if you look at our deficit, it's going to be about $1.3 million, $1.2 million. That's exactly where our interest payment is. So the problem is he's doing such a terrible job, Powell, that our deficit is the same as what we pay in interest. And every time he keeps on raising rates to fight inflation. So what he did this time, he turns around, instead of raising rates, he says, I'm going to cut rates. Instead of 4, I'm going to cut 2. That's why the dollar dropped. Everyone say, what the hell is going on? It's just like in September when he raised the Fed rate 50 basis points. What happened to the 10-year Treasury? It went the opposite way, went up. When you cut a Fed rate, it goes down. And then the 10-year Treasury goes down. That means your mortgage rates go down, your car rates go down, the loans on your car, everything goes down. But no, this time it went up when he cut rates at 50 basis points. So there's a big problem going on here. But he won't admit to it. More when I get back. Join my gang.
Want more information on this show? Go to philsgang.com or give them a call at 877-600-GANG.
At St. Jude Children's Research Hospital, we're fighting against childhood cancer every day. At the heart of this battle are our donors.
Most of us want to make some type of difference in the lives of others. St. Jude does miraculous work.
The fact that no one has to pay, it's a place where everyone is treated as an equal.
Everybody is welcome here, and it doesn't matter your religion or what part of the world you're from, all that is taken away. It just gives you some hope.
It's just a nice feeling to put your energy into something that really does genuinely make a difference in a child's life.
There's just no greater gift. If we have the ability to help, then we have a responsibility to help.
Finding cures, saving children. St. Jude Children's Research Hospital. Find out how you can help at stjude.org.
With the philsgang.com membership, we bring investors right to the floor, into the pits with Phil's daily live webinar classroom. Get inside market guidance on investing strategies. Find out more at philsgang.com or call 877-600-GANG. That's 877-600-4264. Don't have time to analyze and study stocks? At philsgang.com, we recognize that there are all types of investors, and we also recognize that your time is valuable. So we offer investing programs for all individuals. We offer investing programs for long-term and short-term positions. And philsgang.com provides quick and easy to understand investing videos that only take a few minutes to watch. With the philsgang.com investing programs, you will learn technical stock charting, how to execute your trades, and most importantly, you will gain the confidence to know when to get out of a stock and take profits. Sign up at philsgang.com. That's philsgang.com. Or give them a call, 877-600-GANG. Welcome back. Learn, invest, and make profits with Phil Grande. Simply go to philsgang.com. Now, here's Phil.
And welcome back to Phil's Gang podcast and radio show. Remember, join my gang. It's free for 10 days. And also remember, check out my Pro 2 color-coded chart. That chart has been around for 25 years, over 125,000 users. It works. Okay, you really see how it works. It will turn green when you buy. It will, then you're in the stock, and then also when it's going to start selling off, it gives you a warning. It'll turn yellow, and then finally it turned red. So you're in a position now to sell it short. You buy on green, you sell on red. 25 years this thing has been around, so it's been perfected. It works. Check it out, and also don't forget Phil's Gang. We've been teaching for over 25 years. We know what we're doing. We can help you, okay? Because if you keep listening to the jibber jabbers, you're going to get hurt. Right now, anybody could make money in this market in the last 14 years because they shoved in, they printed. The reason why inflation is so high because they printed $14 trillion to stimulate an economy. And why do they stimulate the economy? By doing what? Not increase production. They don't do that. They don't need to. because they can now take money, print it, give it to the banks turn around and give it to companies. The companies don't use the money for business investment. They use money to buy their own shares. So you have stocks going up. Let's use a scale of 1 to 10. So stocks have gone up 9 3/4. But the production is going up 1/4%. And that's why Buffett's selling. And that's why insiders are selling, especially tech stocks. We haven't seen this kind of selling since 2016. The reason they're selling is they know you can't have this kind of economic growth, okay, to debt that we're running, number one. And you can't have stocks at these valuations. Remember, the stocks keep going up, not on earnings. It's all on money support. Money supply. They keep pushing the stocks up with stock buybacks. Remember, the stock market is a mirror image of the stock market. In other words, of the economy. When you put $14 trillion into the economy, okay, and what happens is it's like having a mirror, and all of a sudden the stock market imitates it. It starts going up. Now, all of a sudden, you got these stocks that are insanely high. The valuations are nuts. And that's what's going on right now. But you don't see the market going down because every time it comes down, the plunger team will come in and they will, like they did when we had the 1,123% drop on December 18th, I think it was. And the next morning, we wake up and it was up 300 points. How do you do that? That's the plunger team. They came in and they buy index futures in the morning, early before the market opens. And then the hedge funds see that and say, oh, the plunger team's going to rig the market to go back up. They're not going to allow us to have these losses. So they start buying like crazy pre-market. And all of a sudden, pre-market, you're up plus 300. That's what they do. But that's almost done. Believe me, they can't keep doing this. And also, to fight inflation, Powell keeps raising rates. What happens with that is where we are with that now. As he kept raising rates, and if I got a little chart over here, you can see rates were 0.15. I mean, not even 1/4%. Not even, like 15 points, and it was then 37 points. In 2016, and then it was, for one time, 2020, it went up to 1.5, 150 basis points. But then they dropped it right back down to 0.5%. And from there to where we are today, we're almost at 5%. We hit 5% this year 3 different times. So we've gone from, think about it, from zero, okay, or go from 0.3% up to 485 points. That's insane. So every time he raises rates to fight inflation, that means our deficit, the interest that we are paying on our national debt, keeps going up, and our interest costs on our national debt, or let's say our deficit is let's say 1.3 trillion, okay, and that is what we're spending. We don't have, okay. So nearly that same amount the government is borrowing to pay the interest on the annual deficit is the same as the deficit. In other words, the deficit is growing 130% more than the tax revenue collected. And his job is to expand the labor market to make sure we don't run into this, so we'll have plenty of tax revenue coming in. But he doesn't do it. Instead, he lied. Remember, they had to readjust 850,000 jobs. Remember that? And they're supposed to adjust another almost 1 million jobs, but they haven't done it because they don't want to disclose it before Biden gets out of office. So the biggest problem we have right now, when you fight inflation, you keep raising rates. That means the rates that we have to pay on the interest, okay, we have to borrow money, okay, to pay our interest. So that means our rates keep going up to fight inflation, which means those rates are now that high, and we have to pay our deficit. We have to pay the interest on our national debt. And we just can't keep doing this. It's impossible. So again, Congress borrows, remember, based on 2 years. So when we owe $1.3 trillion in interest on our national debt and we have no money, so they went and they borrowed money for 2023. So they go and borrow money. And then now for 2024, they're going to go borrow money again. So they keep borrowing money to keep paying this interest on our national debt. And the more he fights inflation, the more it costs us to borrow money to pay our interest. So this is why we're going to have a hell of a crash, because you can't just keep, raising rates to go from 0% to nearly 5% to fight inflation. Now all of a sudden, I got to pay the interest on the national debt. How much are you in the hole? Well, we're in the hole about 1.3 trillion. All right, I'll go now. I'll get it. I'll go to the Fed and I'll borrow on 2 years. I get a 2-year note. And then they roll it. Then the next year, this year, 2024, it's going to be worse. So there's no way out of this thing. It's just crazy. So that's why when we saw this market, when we saw the dollar plunge this week, and I mean, what's going on? Well, I just explained what's going on. Now he decides inflation's going up, and he's cutting rates. But he said, I'm going to cut twice instead of 4. No, you should have raised rates. So we're coming to a point that this whole thing that Powell did is a failure. The bottom line, he failed at hitting his 2% target. He failed terribly. And so all these low rates, okay, now are not low anymore. And now you got higher rates, not only on the interest we got to pay, but the government has to borrow money and the interest rates are going to go up. But don't forget, these higher interest rates show up in your mortgages. Your mortgages are going up. The cost of your mortgages, the cost of your home improvement loans, the cost of your auto loans, credit cards, business, they're all going up and up and up. So, but people, all they do is see the stock market going up every day, every day, every day. And why does it keep going up? Well, first of all, starting November 4th, everybody's giddy about Trump being the president. That's a great thing he's president. But we gapped up, and we're up 1,500 points. That's about 13%. That's going to be gone. That's going to be the first, short you're going to have to do. So we are going to give back that big bump, that 1,500 point bump that we got starting in November 4th or 5th. And that 13% bump or 1,500 point bump, that's going to be the first correction right there. So that's why you got to learn how to follow you look on the chart here. We follow interest rates every day because everything from 2008 to 2020 was near zero. Not even 0.25%. But remember, from October 2022, everything changed. We went right from 0 to about 3%. Now we hit 5%. We're going to hit 5% pretty soon. That's killing us. It's killing the country. We can't pay that kind of interest on our national debt on these 2-year notes. We'll get killed. So what we do every day is we follow. Now I want to show you on the chart here. The Pro 2 color-coded charts that you hear me talk about. Here's a typical chart right here. Right? It's green, red, green, red. So every day it's either red, which means it made a new low and it closed, or green, it made a new high. But it tells you nothing. It looks like a Christmas tree. What you want to know, and what we decided 25 years ago, was why can't we show if the more money is coming in instead of going out, it's green. And if money's pouring out, it's red. And look at this. You buy on green, sell on red, buy on green. Doesn't that make more sense than these candlesticks that look so stupid, that are just totally, again, I'll show you, that look like a friggin' Christmas tree? Makes no sense. So that's what we designed 25 years ago. And over 125,000 people use it. Now, the next thing we did to make it even easier for people to make money trading, it's called a sweet spot. You see this little sweet spot? So here, you sell on red, it turned yellow, and then it turned green. But there's what they call a sweet spot right here, and your stochastic. Here's your stochastics right here. See this red line, that's your stochastic. What happens is this. When the market goes down, when the big institutions sell the market, sell a stock, right? Here's what happens. So they sell the stock, goes down like this, but then let's say they made $1 million selling short, the hedge funds. Well, they haven't made $1 million until they buy the stock back. So now what happens is that selling now turns into buying. And so what happens is you get tremendous amount of buying in this small section. So you get tremendous buying in a very tiny area. It's called the sweet spot. And that's where the pros make their money, right in this sweet spot. That's the point on a chart that you have the most money coming in at the shortest period of time. There's 9%. And then, of course, you can go the rest of the way. But we also, when the market starts going down, it's just the opposite. When the market goes down, bam, same thing. You buy on green. When it turns yellow, it warns you it's going to now start going down. Boom, turns red. You have another sweet spot, just the opposite right there, 32%. So this drop was 63%, but the easy money is at the 32%. That's where the pros go for right there. Perfect. So remember, you're following the money instead of the BS. So the bottom line is this here. You're buying on green right here, and you're selling on red, and then, of course, it turns yellow to give you a warning if it's switching from buying to selling. It'll tell you got to switch now. It's turning yellow. So that is what's going on, okay, that we're getting closer and closer to where we're going to get at least a 40% correction, okay? Now, as I said, the first correction is going to not be until probably February, okay? Okay, probably February, the first or second quarter of February. But in the meantime, we got a stark warning, okay, from the bond market. The bond market is Mr. Bond Market tells you what's going on, and Mr. Bond Market's been warning the stock market. Powell's wrong. He's doing a terrible job by keep fighting because he doesn't know how to fight inflation. He keeps raising rates. Now he's got to pay more interest on the deficits. He's got to pay more interest on the national debt. And when you look at the deficit, it's really what he can't pay. I mean, he can't pay it. And now it doesn't work. So follow the money. It doesn't matter if it works or not. Check it out. Join my gang, philsgang.com. Free for 10 days. Check out the Pro 2 color-coded chart. Yes, it works. Believe me. See you on the chart.
You have been listening to Phil's Gang with your host, Phil Grande, on the Off the Wall Street Radio Network. Off the Wall Street Radio Network. Remember to visit Phil's website at philsgang.com. That's philsgang.com. Or call the office, 877-600-4264. That's 877-600-4264.
It's up to me to make